reportedly agreeing to merge in a deal worth better than $150 billion. It creates the world's largest drug maker. Shares of Allergan higher on the news. Want to bring in right now JPMorgan Private Bank Global Head of Equity Strategy, Stephen Rees. Stephen, good to see you.
Great to see you.
Thanks so much for joining us. You've liked healthcare the whole year.
We have liked it the whole year. It did really well. It came back a bit around all the pricing concerns. It's recovering somewhat. I think this deal today solidifies our stance that M&A will continue in the sector and continue to drive valuations higher. But for us, it's really about finding the earnings growth next year. And this year, earnings growth was challenged broadly across the S&P 500. And we think healthcare still looks pretty good heading into next year.
Hey, do you think that the U.S. regulators would move to stop this? They don't want to lose their 10th largest company in America. Would they? Could they?
I think they're going to try. I mean, that's already been reported in the media that they're not happy about this.
Right.
And so, we're going to have to watch it. I think, perhaps the timing of the deal, getting it through so quickly, might be a factor in this whole thing. But for now,
I think regulatory overhangs are a big part of this market, especially on the M&A side. And we're seeing an inversion over here. We're seeing actually in the energy space, there's a big spread in the Halliburton-Baker Hughes deal that's supposed to happen right now. So I think that's a big thing. And we saw Allergan trade down pretty significantly, around 5% on Thursday, waiting for new tax inversion rules. So those inversion rules weren't really an impediment to this deal.
You should explain what inversion is, though. It's essentially that a smaller company is buying the bigger one to get the tax treatment.
Right? Overseas.
Yeah, essentially what happened is an American corporation is going to go buy an overseas corporation to lower their tax rate and domicile over there so they don't have to pay the higher tax rates here.
Stephen, back to the earnings story on healthcare in 2016. We've been bullish on healthcare, too, but we wrote a note on Friday that basically went through demographics and deflation being a potential threat to what has been a fantastic healthcare pricing story. I mean, as you know, it's 50 years that we've seen healthcare pricing. Is there a government or a regulatory or a Hillary overlay to this that concerns you?
Well, I think you're going to see more volatility in the sector next year. Of course, it's an election year. Drug pricing debate is going to be front and center. But we've gone to the numbers. We've haircut drugs. We've haircut companies that have been aggressive on pricing. And we still come out with a growth rate in 2016 that's better than the overall market. I mean, this year was tough. We saw 2% earnings growth, more or less, year to date. Next year, we think overall for the market, we're looking at something closer to 5 to 6%. In healthcare, probably a couple hundred basis points higher than that. So our view on the market is, given where valuations are, you really want to go for the earnings growth in 2016, and healthcare is one place that we see that today.
Given that healthcare growth that you're talking about, can we see a multiple expansion where these names are trading around 16 times PE to go to 18 times, given that there is consolidation in the space that you had mentioned before?
Possibly you could, but our base case does not assume multiple expansion based on the fact that we are sort of trading close to historical averages in terms of multiples. So right now for us, it's much more about the earnings growth.
How do you deal with the earnings? Like, we have earnings growth in the first half of next year down 5 to 10% because this strong dollar is wreaking its, you can see it this morning in copper crashing to new lows again. How do you deal with the first half versus what could be a much better second half of earnings when you look at the setup?
We're obviously watching the price of oil and the dollar very closely because those two things combined this year probably hurt the overall earnings growth by 6 to 7 percentage points. As you move throughout 2016, both of those headwinds become much more benign and perhaps even
particularly in the back half of the year.
So it's going to have a second half story.
I want to know where you stand on consumer discretionary. Of your S&P sectors, had its best week in about 3 years. You had names like, well, not just Home Depot, but Dollar Tree, TJX, Amazon. Ross Stores. They were on fire last week.
Yeah, we've liked it. It's been one of our top picks year to date. I am a little bit more concerned into year and just given how much the sector's run. And if you look at sort of what the retailers are saying, core apparel retailers, the trends aren't great. And so I think this season is going to be really one of winners and losers. You really have to be positioned in e-commerce. You have to be positioned in companies that sell to the home. And then really you've got to have a differentiated or a hot product out there.
And I'll add this, a major luxury retailer breaks its sale tomorrow. Pre-Thanksgiving, you break your major sale, usually starts in December. Yowza. That says business is bad. I'm not saying.
And then pile on terrorism on top of that. And we saw what effect that's having on Paris restaurants and stores. You have to believe if there's a freeze out there that people are afraid of terrorists, they're not going to shop.
I think you do have to be sensitive to the retailers that rely on tourism. You have to be sensitive to the retailers that have exposure in Europe. So it's something we're watching for sure.